Today, an inflation masterclass, part 3, where the rubber hits the road. Hello again, it's Martin North from Digital Finance Analytics World, and that is post covering finance and problem news with a distinctively Australian flavour. Today I'm joined by Damian Klassen from Nucleus Wealth. Hi Damian.
Hi Martin.
Good to have you back on again, and we've been running this series on the big question of inflation, deflation, and what type of inflation are we going to have. And now we're coming to the crunchy bit, which is what are the implications in terms of how you manage your portfolio, how you think about investing, what the markets are doing. And a great timing to have this conversation, seeing as the Fed came out yesterday with an interesting slight drift in terms of the conversation, but probably nothing more than that. But to be interested in your perspective.
Yeah, sure. Because I think that's it very much seemed to me initially like the first reaction you got, not last night but the night before, to the Fed's meeting. So straight after the Fed's meeting, seemed to be very much that people were digging into the tea leaves, and although the Fed, what they were saying really hadn't changed, people were looking at the dot plots and some of the forecasting that was being done and saying, hey, look, it looks like some of the members, even though the overall view hadn't changed, some of the members are starting to move, and so therefore markets sort of swung back and bond yields rose, and that whole value trade was back on, but then quickly reversed again last night. So I think there's and that bond yield trade as well. The big inflation print we had a week ago now from the US was pretty much waved off again. The market very much treated that as being temporary, which is along the lines of what we've been saying.
And of course the lumber stuff, which I've been featuring lumber over the last couple of weeks, because that for me is a classic illustration of precisely what you were saying, right? When price goes up, supply increases, builders buy 3 times as much, right? Creates a worse issue, but then actually ultimately the price settles back down again.
Yeah, and so that's what is it? It went up 400%, was it? Something like that, $400 to $1,700, and now it's fallen 40% from there. So, and you're right. That's a great microcosm, because there's the other part is we had all these lockdowns, and so people who were building houses, everything slowed down because they couldn't have everyone on site to do it, and so you've got previous projects that were delayed and are still going through, and then everyone's decided now, actually, I don't want an apartment. I want a house, and so therefore, or I need an extra study, or I need an extra whatever. Now I'm going to be working from home more often. There's all these things I need, and so there's this huge sort of pent up demand. But once you've built your second study, are you going to build a third study or a fourth? There's unlikely to keep going once you're at that stage, and so this real pig in the python part, and then. For me, that was one where I think the supply side is very much about the sawmills, just getting enough people in there to cut the lumber. I think there is enough supply behind it for the short term needs. It's more just the frictions of actually getting enough people to work on these in these mills and get the lumber out through the various transport and into the hands of the people who want it.
And I guess the only question I have is whether there are some differences in Australia, because we have more of our stuff coming in overseas, so therefore we're more reliant on transportation costs, and we know that the freight costs are still very high, whereas of course in the US they've actually got more manufacturing capability locally.
Yeah, that is true. I think it's not the same for every product, obviously, but the net effect of a lot of particularly commodity inflation is a lot less than people think. So even if you took something like a loaf of bread, and you go, well, wheat prices have increased dramatically. Does that mean if wheat prices are up 50%, does that mean my loaf of bread is up 50%? It's like, well, no. Most of the cost of that loaf of bread is actually in the wages, either to ship it around the place, or to put it in and out of the oven, or to mix it, or whatever. There's a lot of capital equipment that's sort of gone into there that isn't changing in price. And so the change in the wheat price doesn't actually make that much of difference. And it's similar back with the lumber, is that, yes, lumber has increased, and that'll make a difference to the cost of the houses. But most of the cost of the house is the person putting the lumber up and hammering the nails in and things like that. Like that's really where in a Western society, where most of the costs are, or sorry, not a Western, a developed economy, that's where most of the costs really are. And so you can overstate how much those input costs are going to have on the final output cost.
And it's interesting because, of course, if you look in the UK, for example, there the wage growth has actually increased. But if you actually parse that out, the reason it's increased is not because the private sector or even governments are paying their workers more. It's because of the artificial effects of all the stimulus. Right, which means it's going to reverse away again. So pretty much wherever you look, there isn't really much evidence yet of wages increase. And as we discussed, that really is the touchstone in terms of inflation. Yeah,
and there's an interesting curve called the beverage curve. I don't know how much you've looked at that, Martin, on your show before, but that's one where it's basically a line between the number of job vacancies there are and the number and what the unemployment rate is. And so, as you'd expect, is that when you got lots and lots of job vacancies, the unemployment rate's quite low, and then if there's not many job vacancies, then the unemployment rate tends to be quite high. And it's sort of like a curve that slopes down. And what you saw in the financial crisis was the beverage curve was sort of on this line, this relationship between it, and then the financial crisis happened, and it actually took a big step up and to the right, so to speak. And so what it meant was that your unemployment rate was higher, and was, for me, was really what it's showing is this structural change where prior to the financial crisis, we had all these people building houses and real estate agents selling them, and mortgage brokers doing that type of stuff. And then that whole thing finished, and you had to say, well, we don't need X% of our population to be real estate agents now. If we're not all flipping houses to each other, we actually need them doing other things. And so you had a structural change, and that beverage curve took 10 years to sort of come back to where it was prior to the financial crisis. And what we've seen so far from the pandemic crisis is it's taken another step up, even above, like well above where it was in the financial crisis. And for me, that's largely because there's been a huge structural change in terms of the number of, say, air hostesses and anyone involved in the leisure sectors and travel sectors are sort of haven't been needed. They probably will be needed, or certainly a portion of them at some time. So there's been this structural shift upwards, and way more people needed in the goods sectors because that's where all the demand is. But I do think that'll come back to more services, and so it's sort of like that mix of saying, well, there's just some gums up the works a bit. There's a bunch of people out there who say we're air hostesses who might need to now be move to a different industry, and whether that's something in the manufacturing or it's something in goods, or whether that does mean that as services reopen, there's more, they can go to waiters or whatever it is. But there's a structural shift which will take just time before people say, oh, well, no, I'm an air hostess. I'm looking for jobs and I can't find them. To saying, okay, well, now I'm no longer an air hostess. Now I'm a waiter, and I've moved to a new industry, or now I'm a receptionist for a company and for a manufacturing company. But it just takes time for people before they make that shift. And
one other observation on that, of course, if you think about productivity and productive jobs, right? A lot of service sector jobs really are not that productive, right? If you think about all the aged care workers, they're really, really important. But, once you've got one aged care worker, they can do so much. They might be marginally helped by better technology, but only marginally. It's not a massive productivity gain. And that's one of the other reasons why productivity around the world is probably quite a lot lower, because effectively more and more of the activity is service related rather than actually value creating, manufacturing created.
Yeah, and the other part for this, because we've got such low wage growth, is especially in a lot of those sectors, is how do you measure the productivity in terms of looking after an aged person? So, if you were, say, let's say a nameless federal government somewhere that decided, well, maybe rather than one person for every 5, we can get it to one person for every 7, by just providing a little bit less for everyone, is that productivity gain? Like, is that?
That's a great question. That's why New Zealand is quite interesting, because they're starting to say, well, maybe the whole concept of GDP and measuring it, that way isn't right. Maybe we need to have a wellness or a benefits measure as well. In other words, what is the mutual benefit to the whole of society? And I think that's quite an interesting way to think about it. But of course, rational economists throw their hands up in horror and say, you can't do that.
Yeah, and the other part though as well is I think a lot of those roles, and I'm not sure whether that's one of them that gets measured in this way, but certainly a lot of, say, public service roles get measured as what's the wage growth of the people within it, because we don't really know what their productivity is. What's measured as wage growth, and so if wage growth is really low, then they mustn't be very productive.
So a question then is public sector productive question mark. I'm just going to leave that hanging. So look, I think the conclusion is that the thesis that you developed over the last 2 or 3 weeks is still very much intact, right? That we are seeing probably some transitory effects rather than actually structural inflation. But there is also still some risk of inflation, maybe, if they make a policy misstep. So how does that translate then into how you think about investment strategies and portfolio management? Because obviously there's one thesis that looks as though it could well be reasonably coherent, and yet there's also a risk that it might actually not be the right one. So how do you deal with that?
Yeah, certainly. So the way we've treated our portfolio is to break it into steps as to, if we were certain about particular measures, where would we be? And so earlier on this year, we were quite sure that what we'd see is an inflation scare. Is it once we saw the numbers, so whether the inflation was real or not real, we were pretty sure the market was going to treat it as real and react accordingly, because there'd been so long without inflation, and so many there's so many people out there in the start of the year warning about hyperinflation, how we're going to lead to all the things we've seen. If you've been talking for 10 years about inflation, haven't seen any, and now all of a sudden we have got inflation, you'll be screaming from the rooftops and appearing on every news channel you can and things like that. So what we did then is our bond holdings, we very much went to the short end of the curve, where central banks were sort of basically had told you what the yields were going to be, and that they wouldn't move, and we wouldn't be that much affected by rising bond yields. We went with a lot of value stocks, things like banks, which benefit as the yield curves steepen, and cyclical stocks, and so that was not with a view that saying we thought that was where it was going to be. We just wanted to make sure we weren't underperforming the market too much as it moved towards that. And then the question is saying, okay, well, if the inflation isn't real, when do you actually take the step back and move back into the opposite trade, which is going longer in terms of bonds, longer in duration. So you're buying longer term bonds. When do you go to buying more growth stocks, buying more quality stocks, and the stocks that, and some of it's not stuff we buy ourselves, but it's the sort of junk growth. It's the Teslas and the people like that who just don't have earnings, and so you're valuing it on a discounted cash flow, a future, and it's all the stocks that we saw boom in that sort of November through to March period or February period. And so if you're certain, you'd sort of jump into a portfolio of those. And if you're certain that it was going the other way, you'd keep your value stocks. And for us, over the last month or so, it's been about moving from our value portfolio back to a neutral portfolio, and now starting to come out the other side into some of the growth. And what we've tended to do is to let's take our bond portfolio as the most boring part, which I'll talk now because otherwise people might switch off. Is that what we've done is gone to a more neutral position on that. I was actually hoping bond yields would get even higher, sort of up closer to 2%, and then we would sort of pile in a bit more into the longer end, but they haven't. So you just with a lot of these things, you say, well, If bond yields are closer to 1%, then I'm starting to get out of that trade. If bond yields are closer to 2%, I'm definitely in that trade, buying some of the longer term ones, and we're sort of roughly in the middle. So I'm sort of neither. I'm about neutral in terms of our duration there. But that's different to where we were 2 or 3 months ago when we were pretty sure yields were rising, bond yields were rising. Then we look at the equity side of it. What we've tried to do is really take off some of the risk parts where we do think there's going to be downside. So for example, banks, we're now quite underweight the banking sector. I spent probably half an hour talking about commodity markets on one of these prior podcasts and the issues there. So and how we thought that was very much close to the peak of the cycle, and so very very much underweight materials sector. We've moved into the defensives. So traditionally, when you talk about defensives and stocks that are leveraged to interest rates falling, it's things like real estate trusts, utilities, telcos. Right now, real estate trusts I've got some problems with, especially some of the commercial and the commercial and some of the retail. I'm still not convinced that the numbers are right on that, and I think it's a little bit, the risk is quite high in some of those. So we've tended to go for more non-traditional REITs. So some of the ones we hold in our portfolio are things like a storage REIT, public storage in the US, with a view that, look, people have been buying a lot of junk. They'll need somewhere to put it. There's the world's biggest REIT actually happens to be isn't even a property REIT. Well, sorry, isn't even an official property REIT. It's American Tower, which actually rents out mobile phone and 5G space to telcos. So it owns the towers. Doesn't actually own. Often it doesn't own the land. It actually just leases a spot and it's built the tower, and then the telcos come and put their equipment on it. So. But they're actually the world's largest REIT, and they've got some interesting growth from 5G, and particularly because there's so many more towers needed now that we don't think we think it's much more likely that telcos will be happy to put on somebody else's, rather than with 4G and 3G in particular. They often were happy to have their own tower, but because they need so many more towers, we think they're happy to share and have lower costs. So that's it's a little bit nuanced in terms of that. In the utility space, there's a lot going on in terms of climate change and changing demand patterns and things like that. So we're a bit circumspect about which ones we're buying and how much exposure you have to say fossil fuel and how much capex needs to be done. So we've got a bit of an exposure there, but not as much. And so we're probably picking up a lot more of our defensive exposure through either some telcos or from more defensive stocks that you see, like consumer staple stocks you see elsewhere. So we sort of moved that part of the portfolio. We have done a bit of the growth side, but the growth stuff I'm looking for is very much what we call quality growth. So we like to see companies that are actually making a profit, and we like to see ones where if not this year, then next year or the year after. The bits where it's like, yes, in 5 years' time, this company's going to be fantastic because it's going to lose money for 5 years and then make a bunch. It's the problem with a lot of those, and especially now, is not whether they will or won't be successful. A lot of them will be. It's just that most of them right now are already priced for success. And history tells us that what usually happens is people overestimate the probability of success for these companies, and so the actual return you get out of them is not as good as you would expect for a company that's grown as strongly as they have. So we've more gone to the quality growth end. In Australia, that might be companies more like a CSL. In overseas, it's companies like your Microsofts and your Facebooks and your Googles. They're actually growing. Still growing very, very strongly, and while some of them are a little bit expensive, they're not as expensive as the junkier end, or certain segments of the market where some of the semiconductors, for example, have got some really interesting stocks with some really great growth in it, but they're just trading on multiples that are just they're already priced for super success. And so if the company is just merely very successful, the share price will probably go down because it's just priced for not even perfection, above and beyond perfection. So
perfection plus. And what about the US dollar? Because clearly you've got quite a lot of exposure to the US, right? Now there are people out there saying the Fed's broken the dollar, it'll collapse, right? And it will cease to be the anchor currency, as it were. Presumably your perspective will be a bit different from that.
Yeah, absolutely. I think the issue is currencies are relative. So you've got to take your pick about, okay, you don't want to own the US currency. Let's say you don't think that's going to be the reserve currency for the world. Well, what's its replacement going to be? So even if it's the dirtiest shirt, the cleanest dirty shirt in the laundry, even if it is a dirty shirt, but it's cleaner than all the other dirty shirts, then that's the one that's going to get worn. So for me, it's the suggestion that maybe the Chinese yuan will take over is I think laughable. We've seen what they're doing with Australia. They have capital controls on there. If you're getting paid in Chinese yuan, you're not sure you'll be able to transfer it back into the currency you want. It's not now, and no time in the near future would it ever be considered as that one. The euro's got plenty of its own problems and particular growth problems. And then once you get beyond that, the yen has been in sort of serial decline for years and struggling with deflation. And any other currency is even at the end is just not big enough to handle the types of flows of becoming a reserve currency. Maybe you can get to something that like Keynes spoke about having this Bancor or something like that. Maybe that's a solution, but that's a long way. It gets spoken about and brought out every now and again, but it's never serious. It's never at a serious point. And so, I don't see that happening. The biggest issue you could have is, a Fed that was out there out of control and just spending too much money and creating all this inflation. But it's pretty hard to say that the Fed is more out of control than any other central bank at the moment. So that maybe they're doing a little bit more than others, but it's not chalk and cheese. It's
And I think that's really important, right? Because I have heard people say, well, the Fed is just inflating to ever. But the point is, it's relative, right? If everybody's doing it, everybody's dancing the same jig, right? Then actually is who's doing the best jig rather than actually not dancing at all, right? And therefore you can't necessarily assume that dynamic is going to be where it used to be, and that means that it's more about the relativity between activities, say, in Australia and the US, rather than just looking at the US. And frankly, there are probably more fundamentally positive things about the US relative to Australia.
Yeah, and the biggest one for me in Australia really comes down to that whole iron ore complex. A little bit the energy side because we are a big exporter of energy, but iron ore and iron ore and coal are both very, very high relative to their historic trading ranges. Iron ore in particular could very, we were speaking about this the other day about saying, well, when Japan entered the world and sort of really grew as an economy back in the sort of 70s and 80s, it had this huge need for steel and iron ore and became this huge importer. And the iron ore price in today's dollars terms, rocketed from $20 or $30 a ton in today's terms up to sort of $60 a ton, and that was like a huge deal bringing this in. And now we are at sort of well over $200 a ton, and for iron ore, and most of the producers can produce it at below $50, and below $40 for a lot of them, and still be profitable, and quite profitable. And so the longer term outlook is very much that that will come down significantly, which we think will come back to the Australian affect the Australian economy at that point, and we just don't have those tradables, and so we'll need a lower currency to be competitive in other markets.
Yes, and of course the Reserve Bank would like the currency lower. And I guess the last sleeper then is to just come back to the virus, right? Because the virus is still not done yet, is it?
No, it's not done. I think there's we've sort of had the view is from a global perspective is that once you get to a certain level of vaccination, and probably more importantly, it's been offered to people, and so the people have made the choice not to, then you're going to start seeing economies open up pretty quickly. And I think that will happen in the second half of this year. Whether it's, Canada's already said, you can travel. As long as you're vaccinated, you can go to countries and come back to Canada. We'll start seeing that. I think the US and UK will be opening up quite soon. Europe probably not far after. They really seem to have lifted their game of the virus. And at that point, it's going to come back to countries like Australia or New Zealand and others who do have travel restrictions, as to saying, well, if the rest of the developed world is traveling quite freely between each other, then why aren't we? And so, maybe Australia will be a laggard on that, but I do think there will be a quite a quick opening once the dam wall breaks. I think it's going to go quite quickly. It's not going to be it won't be a gradual drip. And so that's one area which of our portfolio that we've got some holdings in terms of travel stocks that haven't actually done that well recently. But it's an area which we have an expectation that there is this pent up demand, and I think certainly amongst a lot of older people, I think there will quite possibly be a not only a pent up demand, but possibly a bit more of a impetus to travel, in terms of saying, well, if there may be more lockdowns, I should travel now while I can, or it's a reminder that life is short, so get out and travel while there's an opportunity to do so.
Very interesting. So standing back a bit, the observation I have is that you've illustrated quite powerfully what active management looks like, right? So basically you're reading the markets, you're reading the broader dynamic, and then you're making active decisions about where to invest and how to invest, and then you tune them and change them, right? That's a very different model for, index chasers, isn't it?
Yeah, and pricing's very important as well. Is the other thing I would say is that bonds is a great example of going, yes, the expectation is it will fall, but you know what? The way it's priced at the moment, it's already priced a fair bit of that. So even if I have a view in that particular direction, there's not a reason to chase it. You might have a view on copper as another example. Is yes, maybe the demand might improve for copper, but if the copper price is already at record highs, then there's no need to chase it. And at those levels, and wait for it to come back. And if it's a mixture of working out, and maybe it's easier to use a horse racing terminology for people, is saying, well, if you've looked through the field and you've said, yes, this horse I think is the one that's going to win the race, but it's paying $1.01 or something like that. I'm betting all this money and not getting much of a return for it. Saying, well, I won't bother betting on that one. Let me go and find something that's more attractively priced. And here's one we think might be in the top 5, but I can get 300 to 1 on it. Okay, well, yes, it might not make it, but it might, it's better value than taking something where it's already priced for success.
Very interesting. And so that basically highlights understanding what's going on, but also the relative pricing and keeping a track on that, and then actually being able to be agile enough to be able to, shift and move around, right? And I guess that's one of the powerful things about your particular model, is that ability to be able to tune and change and weave and dive, right? I wonder whether some of the bigger funds can actually do that because of the fact they've just got too much weight.
Yeah, well, that's certainly an issue for some. I think the other thing is, the thing to think about, especially when it comes to super, is that a lot of the big funds they don't make changes. Once you're locked in, they've said, okay, you're this type of risk level. That's what you are. You are what you are, and you're an 80% equities or 90% equities or whatever, and that's what we're going to give you. The ASX is at $8,000. We're going to give you 90% equities. The ASX falls the next day to 4,000, we're still going to give you 80% equities. There's no concept of what to do with prices. It's quite interesting, actually. We've been rated by different. There's different super fund rating companies, and we've been rated by by some of them, but there's one in particular that quite a large one that basically turned around and said, well, we can't rate you guys. And we're like, well, why not? And it's like, well, because all our other guys don't do this. They don't move around. They're just like, they set themselves to, and it's like, well, yeah. Anyway, so that's their decision is that they don't think we're comparable to most of those other bigger super funds because it's the point of the Titanic in this direction, and that's the way we're going. Iceberg or no iceberg. Whereas I think there's, for me anyway, it is about taking those tilts and then every now and again, you might need to turn sharply, but for the most part, it's about saying, tacking your direction a little bit one way, a little bit the other way, and just sort of leaning into cycles rather than just letting the cycle take you.
Yeah, the analogy I'm thinking here is of the Spanish Armada and, flying up the coast towards the UK, all the little English boats went round and round and round and actually were able to outmaneuver the big guys, right? That's not a bad analogy, perhaps, for what we're talking about.
Hopefully, yes, yeah. And I think as well, the other thing, we have a big focus on risks is the other part. And so that's the other thing to remember with these is that even if there was no sort of outperformance at all, you just went from one point to from point A to point B. If you can move there in a pretty straight line or with quite low sort of volatility within that, I think there's even there's a benefit just to that rather than being in one where one day you're up 20%, the next day you're down 30%, and so it's a part of that whole leaning into the cycles to give you a much smoother ride along the way. I think for a lot of people is a benefit even if even if there's the difference in the end doesn't end up being that much. It's getting that lower volatility because things will happen that you just don't know about. You're into your retirement and there's a sudden medical emergency, or you have a child who's getting married or something like that, and there's you want to be able to help fund those. If you're sitting in a portfolio that's doing these really ups and downs and quite volatile, is that you never know whether the day you really need that money is the day that everything's fallen, so something that's got a much steadier rise, really gives that benefit for investors and as they're using the money.
And that's, of course, the concept of the nucleus, isn't it, in Nucleus Wealth, right? It's to have that core foundational element within the investment portfolio that is actually more predictable, is managed well. And then if you want to speculate around the edge in crypto and other things, do that. But it's not part of the core, right? Because the risk is, if the core is very volatile, you don't know where you are.
Exactly. And so the other part is I want to be able to give transparency as to what we're doing, and that's why we do these types of shows. And if you register on the Walk the World, you'll get to see these types of our more detailed reports into this and sort of showing you how we are positioned. Because the thing is, if we're sitting here with a core positioning, and for example, you want lots and lots of gold, a year ago you might have you would have looked at the portfolio and gone, okay, they do actually have a lot of gold. I don't need to buy as much in my sort of satellite around that. Whereas right now you'd look at it and go, okay, the Nucleus don't have anywhere near as much gold, and so if I've got a particular view on that, then I can buy even more or whatever it is. So that the idea is that we want to be there is to for some people it's the whole amount of their investment, but for people who do want to be able to do those sort of satellite investments, you can see what we've got, and then you can actually put your own investment strategy, merge that with what we're doing. Whereas with a traditional super fund or a traditional investment house, quite often you've got no idea what actual assets they own, and whatever you're doing in your own name might just be either doubling up or working at cross purposes with what they're doing.
Yeah, that's a very good point. Well, one of the reasons why we teamed up was because I really like the transparency and openness that you guys have. Good performance as well is pretty helpful as well.
Helps.
But I think it is that transparency, openness, the ability to be able to actually see what's going on, and people can actually make decisions within that portfolio in a way that is very powerful. So I found that a really fascinating discussion. I think it rounds out nicely the series on inflation. I guess we'll have you back on and talk about the markets ahead as normal.
Yep.
We'll put the links and things below. But my last question for today is this. What is the one indicator that you'd actually be watching very cautiously to say, hang on a moment, no, inflation is really now starting to get out of control?
Yeah, absolutely. Wage growth. It's all about the wage growth. And it's it's the detail of the wage growth. That's where, and I'm coming out with a written piece later on next week. That's sort of going into a bit more detail. And that's probably one. Next time I'm on your show, we should have a talk about that. So again, register on the Walk the World if you want to get some of these written pieces. But because we spoke about how much of this is this whole super cycle and super cycle in inventories, and how it's all about the wage pressures, and we've had a bigger switch to services, and so really watching that wages to see when we start to get lift off. That's the key sign we think that'll show we'll be wrong. The other, a good point as well. What else could go wrong? I mean, the other big one, policy error, and so the most likely source I think of policy error would be if we have an extended period of this inventory super cycle going on. So let's say the frictions last a bit longer. Let's say they last another 3 or 4 months, and we've already seen the Fed start to move some of their dots based on 2 months of inflation. If it gets to 4 or 5 months of inflation, then I think they will definitely be moving their dots, and the market might end up pricing pricing in rate cuts just as the inflation all disappears and rates have already risen, and so you've actually damaged your growth, and you end up with some problems there. So we're certainly looking for potential that you do need to scale back your equities positions. So there are two big risks. One is you actually do get wages growth. The second, probably bigger risk, I think, especially in terms of equity investors, is that the temporary inflation lasts for a few months longer, and the Fed and other central banks start to move on that. And just as they start to move, the inflation comes off, and so they've actually damaged their own growth.
Yeah, well, watch for the signs, I guess, ahead, because it'll be an interesting ride. I really appreciate your time today. Fascinating conversation as always, and we'll look forward to picking up again down the track.
Thanks, Martin.
Thanks very much. See ya.